Welcome back to MMG Invest and WolfPack Cryptos. In today's video, I will do some commentary on the Three Stooges here, Jerome Powell, Janet Yellen, and Ben Bernanke. And I will also cover the markets a little bit. Now, we did see an 830-point rally today, right after the Fed chairman spoke during the panel, right? And I will cover that in a little bit more of a detail. But what I found very interesting about that panel was that they're missing one person, and that is the predecessor to all these Federal Reserve chairmen, and that is Alan Greenspan, who started this debt-driven Ponzi scheme bubble in the early 90s, right? And his predecessor, Paul Volcker, who raised interest rates 20% to stop runaway inflation in the late 70s, he is already deceased, right? But Alan Greenspan, 2 months ago, he was on CNBC promoting his book, and he was actually speaking a lot of truths. Now, I did make a video on this 2 months ago, right when he did that, because I happened to be watching CNBC when Alan Greenspan was on, and he was dropping a lot of truth bombs about unfunded liabilities, how the government can't pay out all the social welfare programs and whatnot, and how they really can't unwind their balance sheet. And if you're interested, you can watch that video. If you go to my special playlist on MMG Invest YouTube channel or on WolfPack Cryptos YouTube channel, it's in the special videos playlist, as you can see right here, special videos, and you'll find it. There's a picture of Alan Greenspan. Now, the panel. I will provide some commentary on this as we go through this. All right, guys.
If you think it's been bad, you have these three people to blame. Ben Bernanke, after a long academic career, mainly at Princeton, came to Washington as a Federal Reserve governor, and then chaired the Fed from 2006 to 2014. Janet Yellen, after a similarly accomplished academic career at Berkeley, served as a Fed governor, president of the San Francisco Fed, and chair of the central bank from 2014 to 2018. And Jay Powell is a former Treasury official and private equity executive. He has chaired the central bank for the last 11 months. Chair Powell is not an economist, actually. He has a law degree. This does sound like the start of a joke. What happens when a lawyer walks into a conference with 13,000 economists? The punchline is, we're about to find out.
All right. Well, that is funny. I did not know that Jerome Powell was a lawyer, and he's not even an economist. I mean, that's fine. I mean, these are all pretty much politicians at the end of the day. I mean, the Federal Reserve is supposed to be separate from the federal government, although it's called the Federal Reserve, but it's not federal at all. It's private. So it's funny how they name these things and the types of people that run them. Now, of course, they're all Ivy League, highly educated people from Princeton and Yale and blah, blah, blah. And these are exactly the type of people who run society these days, and that is exactly what the problem is with the economy and society these days. Now, here's the thing. Jerome Powell was appointed by Trump. Keep that in mind as we go ahead. And I will also show some predictions Janet Yellen has made, how she's flip-flopped on them. And they will be talking about how they are independent from the president and the federal government, yet they have great relations with them. And it's going to be really interesting, and the hypocrisy you're going to see here.
So let's dive in first with you, Chair Powell. Since the December FOMC meeting, it was only 2 weeks ago, shockingly, markets have been volatile. We've seen some real pessimism in some economic surveys. We also saw a blockbuster jobs report this morning. Look, you've been optimistic about. Is that changing? What is your outlook for 2019 and beyond?
Well, thanks very much, Neil. It's great to be here. Also great to be with Janet and Ben, as always. I'll talk a little bit about 2018 and then turn to the outlook, if I may. So 2018, by so many measures, was a good year for the United States economy. And most of the hard data that we see coming in remain quite solid and suggest ongoing momentum heading into 2019. You mentioned this morning's jobs report. For those of you who haven't seen it, we had 312,000 payroll jobs added, a very strong number. We have unemployment remaining below 4% for 9 months now, the longest period since the mid-1960s. We have labor force participation picking up again and surprising to the upside, which is very, very welcome. And finally, we have wages, which are continuing to gradually move up. Average hourly earnings moved up, and that's quite welcome. And also, for me at this time, does not raise concerns about too high inflation. So very strong report today. We've also seen.
All right. Well, today the market rallied for two reasons, and that was the jobs data and because of this panel. Now, he's talking about the economy and all the data that he just spewed out there about wage increases and everything else he just said. The problem with the economic data that comes out, and most people don't know this, well, average people don't know this, that the economic data is actually put out by the Federal Reserve itself. It's data for themselves. And one could argue it's very skewed data. And, the best way people like to lie, politicians and everyone else, corporations, everyone, accountants, and it's through statistics and accounting and double accounting. And the way you skew statistics, I don't want to get into it, but it's one of the ways the most and the biggest lies are told in modern day and in the past as well. Now, the thing about their data, you have to know this, that in the late 80s, I believe, and in the 70s, they used to calculate the economic data differently. And it wasn't, and today it's not really adjusted for inflation properly. And then they've taken a few things out and put a few things in, like utilities. And what it does is it projects economic growth to be higher than it really is, and it dismisses inflation as much as humanly possible. So all the economic data they put out today is definitely skewed to be more rosy, okay? It's like pumped up numbers. It's like when corporations put out their revenue reports and whatnot. Now, you could go to shadowstats.com and they will show you real economic data the way they used to calculate it 30 years ago. And it shows completely different numbers. Inflation's much higher than it used to be. Wage increases are almost non-existent. They are there, but, it's not keeping up with inflation. And that's why the standard of living of Americans has been deteriorating as time goes on. I mean, think about it. I mean, this is very simple. In the 70s and below, you had one man who was able to support like a family of 7. The wife didn't have to work. The kids, their college was paid for. They had multiple cars and they had a paid off home. Nowadays, you have 2 people working, no kids, and they're barely keeping their heads above water for the middle class. All right?
On a more forward-looking basis, we've seen initial claims for unemployment insurance near their historic lows, and so that's more of a leading indicator, and we still see real strength there. Consumer spending has been strong right through December. The reports we're getting from the retail industry suggest continuing spending right through the holiday season. I would say those are all good data points. There is yesterday's.
Now, the consumer data in retail, we just had Christmas, so of course it's going to be good. It's going to go up. Now, the funny thing is, if you actually look into the consumer and the retail shoppers, they've actually, see, they dismiss other data though. They never talk about other data. They only talk about the data they want you to focus on. If you actually look at the consumers right now, and I don't want to go into it, but I will show this on a separate video when I go into fundamentals about economics. I will make that video, I promise, this weekend. Credit cards have been maxing out, and the consumer is going deeper and deeper into credit card debt. And that is what was fueling this Christmas shopping season. Now, it is irresponsible a part of, the citizens to do that. But, after all, America is a consumption-based economy. That's why when you drive around the entire United States, what do you see? All you see are endless shopping centers. Endless and endless shopping centers. Endless retail and service. And this is all retail and service sector. The problem with that is it's not sustainable for any country. Now, what you need is more manufacturing. That's what you need. Because at the end of the day, this country has to sell something besides its own debt to the rest of the world. We just can't live off of giant modern day flea markets. We actually have to build things and sell them to the rest of the world, right? Or at least sell resources, something. And, soybeans isn't going to cut it. We do also sell gas, but that's not going to cut it either. At the end of the day, it's going to come down to manufacturing. And the PMI numbers, or the ICM numbers that came out yesterday did tank the markets, and Jerome's going to talk about it in a second.
Institute for Supply Management report, which came in well below expectations. And I would just provide a little bit of context there. The ISM report is a survey of manufacturing conditions, and it had been at historically high levels, in fact, higher than it had been even in the strong expansion of the late 1990s, and much higher than it had been during much of this expansion. So it's now at a level which is considered consistent with ongoing moderate growth, and is about at the level or even higher than it's been in the earlier years of this recovery. So that's...
All right, so let me explain this to you with the manufacturing data. The ISM report, right? If I could find it. Well, here's manufacturing production. Now, manufacturing has also been in a bubble, although it's only 10% of the economy, and it should be like much, much greater. It should at least be 20%, 25% to justify all these service sector and retail jobs. Because you have to remember, service sector and retail and all of that is a byproduct of manufacturing at the end of the day. The United States used to be a manufacturing powerhouse. That's when the United States was actually the richest country in the world. No longer so, because we don't have any more manufacturing. Now, even the small 10% of our GDP is manufacturing, but in reality, it's probably even less. If you take away inflation and the bubble effect, the effect of the bubble that the stock market's in, and all the lending out there because of artificially low interest rates. So even manufacturing, will fall with the stock market. And honestly, it's not supposed to be like that. So here's the last 10 years, manufacturing. You can see that it peaked out in like 2011, and it's been falling gradually. Let's go to max. Here's, wow, it goes all the way back past 1938 towards the Great Depression. It's been steadily tapering off, manufacturing. And if you adjust this for inflation and bubble blowing by the central banks, this would actually be even lower. All right. So that's the problem. That's the underlying problem. Wealthy nations do not come from money printing and credit and finance and retail and service sector jobs. Wealthy nations are created on productivity, entrepreneurship, and innovation. And that's what the United States has been declining in the past, like, 6 decades here. Or, I don't know about 6, but at least for the past 3 to 4 decades. And that's because of high taxes, high regulations, and money printing by the Federal Reserve. Because what that does is it causes malinvestment, and malinvestment destroys innovation, destroys productivity, and destroys the underlying economy and small businesses and entrepreneurs. The free market, the organic market, what it does is it rewards not malinvestment. It rewards entrepreneurs actually making real things that people need and want. And it does not reward people doing malinvestment and creating things that people don't need and don't want. Let's continue.
A little bit of context. I would say the fact that it moved down so much in 1 month is something worth keeping an eye on. So, notwithstanding that report, though, I would say U.S. data seem to be on track to sustain good momentum into the new year. I'll talk about China for a second. China's been a big part of this story, and
now, before we go into China, I did want to make a couple points here. As you listen to these central bankers, central planners, bankers, because they are you have to understand what does the word central mean? It means centralization. Planners and bankers, what do? Well, they decide where money goes. And they decide capital flows and what money does, and when you could control it flowing through economies and whatnot. What you do is you're in a way you're managing people and how they consume and what they consume and if they save money or do they spend money. And the reason we have a consumption-based society is because people cannot save money because of the level of inflation. You have to understand, if slowly and gradually every year you have an inflation rate of 5%, that is essentially meaning that you are losing. It's like your boss saying, every year we're going to take 5% of your wages. And then what does that force you to do? That forces you to spend all your money because you know, one, it's going to be worth less. Two, you have to spend all your money just to keep your head above water, just to pay all the bills because it's worth less and less every year, right? Now, you have to understand, I do have an analogy that could really explain economics for you and why the economy is really in trouble and why central banking does not work and why fiat currencies backed by absolutely nothing does not work. All right. So this is what the central bankers do. And this is what Alan Greenspan started, right? So every time the free market, or what's left of it, but you could arguably say we never had a truly free market, but we had a closer to a free market 3 decades ago than we do now. Every time the stock market and the economy has a small recession or pulls back or has a correction, the free market, when it has a correction, what it does is it flushes out the malinvestment, flushes out the bad debt, flushes out people doing dumb things. And they have to be flushed out so the economy becomes stronger and grows and adapts, right? Well, because we have central planners and politicians and governments and central bankers, they don't like the corrections. They don't like the pullbacks. And what they do is, because it's politically expedient and politically best and politically for their best own interest, what they do is they don't allow the free market and the economy and the stock market to flush out all of the bad investments. So what they do is they'll print money and lower interest rates, right? And what that does is it creates a bigger problem down the road. They keep kicking the can down the road. And what it does is not letting the market flush out all of the malinvestment and all of the problems. What they do is they create a massive bubble, which in the long term destroys productivity and destroys the real underlying economy because of malinvestment and inflation and just what it does is it becomes a Ponzi scheme. Now, here's my analogy. It's just like we just had the forest fires in California. Now, with good intentions, the regulators down there and the state, they don't allow controlled burning. And they don't allow the farmers to do controlled burnings on their farmland. And they don't allow the metro parks to do controlled burns. What they do is they constantly put out the small fires. And what happens in decades and decades of time is they never have a decent sized fire within the forest. Well, it's natural for the forest to have forest fires like every year. And what happens is the ground of the forest becomes saturated with branches and debris and leaves and brush, and the forest becomes very dense, right? And one summer, after many decades of them letting the forest overgrow, it becomes very, very dry, and then one summer all it takes is a small spark and a nice wind, a nice breeze to come through, and then the entire freaking forest burns down to the ground. And it's worse than if they just let forest fires naturally happen. The problem is, you know, you have these central planners, these Ivy League smart people who've never actually built a business. All they do is read books, and all they do is have connections in high places, come in and they think they know what's best for us peasants, for us people. And what they do is they screw everything up. Even if they have the best intentions in the world, you screw everything up and everyone suffers even worse than if you would have just let it happen, all right? And that's pretty much my little rant. These central Ivy League planners, they're like Smokey the Bear, but in the end, they're going to burn the entire forest to the ground. And that's what's happening here.
The most recent data from China have been more mixed. China's consumers appear to be pulling back, as seen in the Apple News and in the weak retail sales data. The two PMI reports we got earlier this week show softening in domestic and external demand, and this weakness seems to be spilling over to other emerging Asian economies and to global commodity prices such as copper, for which China is such a big buyer. That said, Chinese authorities are responding with additional stimulus, and China and the rest of emerging Asia should continue to expand at a still solid pace this year. So overall, I would say the picture for the rest of the world remains consistent with continued growth here in the United States. So good data still, I think, is the story looking in the rearview mirror. But financial markets have been sending different signals of concern about downside risks, about slowing global growth, particularly related to China, about ongoing trade negotiations, about what maybe let's call general policy uncertainty coming out of Washington, and among other factors. So, you do have this difference between, on the one hand, strong data and some tension between financial markets that are signaling concern and downside risks. And the question is, with those contrasting sets of factors, how should we think about the outlook and how should we think about monetary policy going forward? Now, when we get conflicting signals, as is not infrequently the case, policy is very much about risk management. And I'll offer a couple of thoughts on that to wrap up. First, as always, there is no preset path for policy.
All right, did you hear that? For one, he already started pivoting towards the trade war, and that's to blame Trump for everything when everything starts falling apart. The thing he just said that is very crucial and very important, and why the stock market just rallied today, is the fact that he said there is no preset path. Meaning, once they start a tightening cycle or they start raising interest rates, that doesn't mean they're just going to keep going and going and going if the stock market keeps falling and falling because they're popping their own credit Ponzi scheme bubble, right? So he just capitulated, and that's what just happened. He just capitulated. He just signaled to the market, don't worry, we have your back. If things get too ugly in the stock market, we will lower interest rates, and then, if need be, we'll come with the QE4, which is money printing.
and particularly with the muted inflation readings that we've seen coming in, we will be patient as we watch to see how the economy evolves. But we're always prepared to shift the stance of policy and to shift it significantly if necessary in order to promote our statutory goals of maximum employment and stable prices. And I'd actually like to point to a recent example when the committee did just that in early 2016. And I mentioned this in this December press conference in passing. As many of you will recall, in December 2015, when we lifted off from the zero lower bound, the median FOMC participant expected 4 rate increases for 2016. But very early in the year, in 2016, financial conditions tightened quite sharply, and under Janet's leadership, the committee nimbly, and I would say flexibly, adjusted our expected rate path. We did eventually raise rates a full year later in December 2016.
So what he's saying right here is when they started raising interest rates the very last month of 2015 through 2016, I can show you guys the charts. Janet Yellen stopped raising interest rates. She started slowing down. Let me show you the charts. So here's the S&P 500. This is a 4-hourly time frame, but let me go to the weekly so you can see this. So here's 2016. This is when the Federal Reserve started raising interest rates for the first time in like a decade since the financial the mortgage-backed security financial crisis, right? So they were printing money, and then finally they started raising interest rates. And look what the markets did. They started tanking. All right. So then she had plans to raise interest rates like a bunch of times in 2016, but then they didn't. They started raising them every other like quarter. And then in 2017, they started again raising rates sharply. And Trump was already complaining about that when he was about to become president. This was during the presidential election. And in 2017, Jerome Powell was just raising rates every chance they had. And Trump was complaining about that, but the market kept ignoring it, kept going higher and higher. And now, finally, the market is starting to stumble because it's running out of money. Because as they keep raising interest rates, more money gets sucked out of the system, and then the stock market can't go any higher. So let's go back to the panel.
Meanwhile, the economy weathered a soft patch in the first half of 2016 and then got back on track, and gradual policy normalization resumed. Now, no one knows whether this year will be like 2016, but what I do know is that we will be prepared to adjust policy quickly and flexibly, and to use all of our tools to support the economy should that be appropriate, to keep the expansion on track, to keep the labor market strong, and to keep inflation near 2%. And I will stop there. Thanks.
So Chair Powell, as you note, since the last FOMC meeting, markets have moved in big ways. 10-year Treasury yield is down 0.25 percentage point. The Fed funds future.
For a second. So he said they will adjust accordingly. This is basically the tail wagging the dog. What does that mean? Well, the Fed is pretty much at the mercy of the market. It's not the other way around. Well, that's pretty much what has happened since 2019. Now, in 2019, the Fed was essentially manipulating the entire stock market, pumping it up with QE money printing, right? And artificially low interest rates. Well, now the Fed is stuck. They can't normalize interest rates because they're popping their own bubble. And whenever the market starts tanking, the market is signaling to the Fed, hey, stop raising interest rates, start lowering them again, and keep the money printing going, because if you don't, the stock market's gonna collapse. If the stock market collapses, so will the real economy. And it's not really supposed to be intertwined that much, because you know, the stock market's financial. But at the end of the day, the United States and the global economy has become so financialized and so reliant on loans and credit and money printing, because the productivity doesn't justify the means. Meaning everyone, especially the United States, is living beyond their means. They're just living on credit cards. Okay? The productivity, the actual making of things in the underlying economy does not support all of the debt and the welfare and the unfunded liabilities. It doesn't support all the warfare, and it doesn't support all of the corporations that are really not creating the amount of profit and revenue that they should, if that makes sense. And people aren't as productive as they should be, to justify the amount of money and wealth they have.
Path is suggesting no rate increases, maybe even rate cuts in 2019. Are the markets telling you that you made a mistake?
I think the markets are pricing in downside risks, is what I think they're doing. And I think they're obviously well ahead of the data, particularly if you look at this morning's labor market data and the other data that I cited. So markets are expressing concerns, again, about global growth in particular. I think that's becoming the main focus, and trade negotiations, which are related to that. And I'll just say that we're listening carefully to that. We're listening with, sensitively to the message that markets are sending, and we're going to be taking those downside risks into account as we make policy going forward.
Now, at your press conference, you affirmed that you intend to allow the balance sheet to continue shrinking at a steady rate. Would you reconsider those plans in light of this flexibility you spoke about a moment ago?
Yeah, so let me talk about the balance sheet. Some years ago, we decided that that rate policy was going to be the active policy tool, and that the balance sheet would be allowed to shrink gradually and predictably in the background. And it was supposed to be about as interesting as watching paint dry, in Janet's famous locution. So, and that division of labor has served us well, and we think has served the economy well. And so we also said at the very beginning, I think in our original, certainly the first policy normalization plans that I was involved in 2014, we said that we would be prepared to adjust our normalization plans as appropriate to achieve our goals. So if we ever came to the conclusion that any aspect of our normalization plans was somehow interfering with our achievement of our statutory goals, we wouldn't hesitate to change it. And that would include the balance sheet, certainly. So I would say today, of course, we're
He just said they wouldn't hesitate to change it. I mean, this is full-blown Fed capitulation. And he's talking about all of the debt and bonds they bought. They're letting it mature, and they're letting it roll off their balance sheet. It's like $600 billion a month, something like that, something insane. Now think about that: $600 billion a month debt, and well, not debt, but money being sucked back out of the economy, and that's why the markets are going back down. I mean, there's no more money, cheap money, to inflate it back up, right? Because you're going to run out of buyers at some point. And all the money printing was, you could say, the biggest buyer in the stock market and the economy as a whole.
Hearing a lot from different groups of people about the role that the balance sheet normalization may be playing in the markets. I think we are of the view that what really happens mechanically when our securities mature is Treasury issues a comparable amount of securities, but they do so across the yield curve. The amounts are not that big. They haven't been that big compared to the issuance Treasury has already undertaken. So we don't believe that our issuance is an important part of the story of the market turbulence that began in the fourth quarter last year. But I'll say again, if we reached a different conclusion, we wouldn't hesitate to make a change. If we came to the view that the balance sheet normalization plan or any other aspect of normalization was part of the problem, we wouldn't hesitate to make a change.
So let's broaden our conversation now. Dr. Yellen, if this expansion...
We wouldn't even hesitate. I mean, does he understand the implications of what he's saying? Now, with the Fed capitulating like this, it's actually really bad for the long term, because what it means is we're going to have runaway hyperinflation, pretty much. Also, I wanted to show you guys, Janet Yellen's about to speak, and she is the best at putting you to sleep with a bunch of rambling and nonsense. It's funny, I just wanted to show you this. June 27th, 2017, Janet Yellen said, "I don't see a financial crisis occurring in our lifetimes." And then, when was this? December 11th, 2018, Yellen warns of another potential financial crisis. Gigantic holes in the system. I mean, it's so funny. And then, of course, we have the Bernanke, Dr. Ben Bernanke, who was paid by Ripple. Ripple, one of the worst cryptocurrencies out there, which has no real purpose in life. Ripple, and he spoke at their event. How funny is that? This is the great life of after being a Federal Reserve chairman. You go around and you get paid hundreds of thousands, if not millions, to speak at events and to shill the biggest garbage out there, like Ripple. Here's what he said about virtual currencies, though. Virtual currencies may hold long-term promise, particularly if the innovations promote a faster, more secure, and more efficient payment system. I agree with that, Bernanke. I do. I wonder how much she got paid. Alright, so let's get back to it.
Into next summer, it'll be the longest on record. You played a significant role in making that the case. How confident are you that this economy is on track to keep growing through 2019? How worrying do you find these latest moves in markets and some of the survey data?
Well, I agree with Chair Powell's assessment that he just offered up. The data suggest we have a pretty strong economy. Consumers, consumer spending is 2/3 of all the spending in the economy. With strong job growth and income growth, debt burdens having been reduced substantially, housing prices having risen, oil prices down, putting some money in consumers' pockets. I think consumer spending, and it looks, as Jay said, as though spending over Christmas was strong. That's a strong base for the economy.
That's exactly the problem, Janet Yellen. This entire economy is based off of just consumer spending going into debt on credit cards with high inflation. So what happens when the consumers stop consuming and during your tightening cycle of interest rates, which is the interest rate on all debt, right? Credit cards and home mortgages, interest rates on loans. What happens when the consumer slows down and stops spending? A massive correction and the popping of a bubble.
Next year, I don't think that expansions just die of old age. Two things usually end them. One is financial imbalances, and the other is the Fed. And usually when the Fed ends a recession, it ends in expansion, it's because inflation has gotten out of control and the Fed needs to tighten to bring it down.
That is true. And she actually admitted something. They end recessions and they end expansions. And that's because they're pulling levers, right? And they're guiding the economy like they're like the Wizard of Oz, the Emperor, behind the curtain. But then you're going to find out they have no clothes. And this time around, they can't raise interest rates to stop inflation. They can't. That's the problem. And that's why we're going to have runaway inflation. That's why they can't raise the interest rate past 3% and they're already popping their bubble. Do you understand? Normal interest rates are they're around like 8%. They're not below 3%. That's the problem. They can't normalize interest rates anymore because they've blown such a huge debt bubble. And I wish I was sitting next to them because I would destroy them, right? But, and you know, it's funny. So let's continue.
And I think the Fed is now very well positioned with inflation being low and inflation dynamics being favorable in the sense that the linkage, so I believe that there is a linkage between slack in the labor market and product markets and inflation, but the strength of that linkage is not very great. So we have a relatively flat Phillips curve is another way of putting that. And in addition, inflation expectations seem well anchored, and so inflationary dynamics are very favorable. It gives my former colleagues the opportunity to be careful, to move gradually, to be data dependent, to manage the risks, and I have confidence that they'll be able to do that. And I don't really see financial imbalances in the economy at this point that look to be threatening. So, of course, we have had a tightening of financial conditions.
Wait, didn't I just read that article from December 11th, 2000, when was that? That she said that a crisis is coming? It was, yeah, December 11th, 2018. She did also say it's because of deregulation and pretty much Trump. But she just said again that she does not see a recession coming.
Markets are obviously worried about downside risk. There are we are seeing some slowing in the global economy. I believe growth is likely to slow quite a bit next year, but still likely end up being above the growth rate of potential, which is consistent with a strong labor market and maybe even some further tightening.
Dr. Bernanke, you spoke once of a Wile E. Coyote effect as this fiscal stimulus impact of the tax cuts fades, that we might find ourselves in a bad spot over a cliff looking down. Are we looking at that now? Is that part of what's being priced in, and how much is that fear something imminent?
Well, I think we have an excellent chance of breaking the all-time record for an expansion, a 10-year expansion in the middle of next year. It's likely that the economy will grow more slowly in 2019 than in 2018, and maybe even more slowly in 2020. This is not something that is news. I mean, we've anticipated this for a long time because the fiscal policy in particular that was enacted close to a full employment starting point, we knew that barring changes in the law that stimulus was going to be dying down over time, and that's certainly going to be slowing growth, all else equal. Financial conditions were, if anything, a little bit ebullient, in 2017, early 2018. To some extent, what we've seen, this tightening we've seen, is a take-back of some of that, particularly with concerns about geopolitical considerations, trade wars, and the like. And then, of course, the sort of perfect confluence of synchronized growth we saw in 2017 is also, globally, has also been a little bit less strong. So all these things do suggest some...
Let me explain to you. For one, he pivoted to blame this on Trump and the trade war, and then the other pivot is to blame on the rest of the world and the slowdown globally of economies like China, Europe, Australia, Canada, the third world, emerging markets. And you have to understand how this dynamic really works. First of all, yeah, China is way too intertwined with the United States, and that's because the United States has been gutted of its industrial jobs, and China has them now. Has all of the United States industrial jobs that we used to have, which made us rich, and they're stealing our patents. Like, they're stealing all of our technologies. For a company to go over to China, like Apple or any other company, they have to give up all of their patents and their trademarks. Now, Trump is trying to change that with the trade war. And Trump, I think, knows that no one wins a trade war, but Trump is destroying the Chinese economy, so they finally capitulate and come back to the table, and they make some new trade agreements so the United States could bring back industrial jobs, and we don't have a trade deficit. A trade deficit means we are buying more crap than what we are selling. So therefore, we have a net negative revenue. So if you're a company and you're buying more things than selling, what's going to happen in the long term? You're going to run out of money. You're going to go bankrupt, right? But you have to understand, the Federal Reserve, because they raise interest rates, and the rest of the world borrowed a ton of dollars after 2009, the rest of the world's economy is pretty much tanking because the Federal Reserve is raising interest rates, except that the United States economy is the last domino to fall. So the Federal Reserve, because it has the world reserve currency, is what is really tanking China, Australia, Canada, and Europe, because they all have bubbles in their economies as well. And then their central banks what they do is their central banks follow our central bank because we have the world reserve currency. That's really important to know.
Some moderation, but as Janet says, expansions don't die of old age. I like to say they get murdered instead. And right now, right now I don't see anyone's cloaking behind, hiding behind the curtains. But some slowing does seem likely. Let me just say, that it is a good thing that the Fed has the flexibility to respond in a way that will be responsive to the data, responsive to the markets, and that manages the risks that are obviously on both sides of this.
So, as all three of you know all too well, being Federal Reserve Chair is not just about economics, it's about navigating the political system, navigating Washington. That task has become trickier for your successor. Chair Powell, the president seems to be very happy with the rate increases. There's been reporting that he's considered trying to fire you, which would raise legal questions, to put it mildly. Have you received any direct communication from the White House expressing displeasure? Have you received anything direct from the White House about unhappiness with the path of rates, or discussion of any change in your job?
No, I'm not. I have no news for you on that.
There's also been discussion of a face-to-face meeting between you and the president. If invited, would you accept that kind of invitation for the meeting?
So again, I have no news on that. Nothing's been scheduled. I would say that meetings between presidents and Fed chairs is the honor, and they happen.
All right. Well, first of all, the Federal Reserve is supposed to be independent from the federal government, because if it wasn't, they would just print endless money to fund all of the empty promises politicians make to stay in office and power, right? Now, Trump appointed Powell, which is ironic, and Trump's been tweeting nonstop, like, hey, the Fed is going to ruin the economic expansion under my presidency. And Trump has pretty much hanged his hat on the economy. And Trump is trying to get reelected, right, in 2020 based on his policies, which has boosted the economy and has helped the economy grow. Now, of course, 2 days ago, the liberals just took power of the Congress, right? And they, on day one, they're starting impeachment trials, or not trials, but they're starting their impeachment talk already, and that's not good. But what I'm trying to say is, Trump owns the economy now. So if the economy starts falling, he's definitely not going to get reelected. Ironically, during the election, or during the elections in 2016, before he was elected, he was saying that the economy and the stock market's a big fat bubble. I mean, he literally said that. And he said it's because of the Federal Reserve printing money and the artificially low interest rates. And then as soon as he became president, Jerome Powell here kept raising interest rates rapidly. And then Trump is saying that they're political and they're raising interest rates so the economy and the stock market starts falling so he doesn't get reelected. And that's the political thing going on here. Now, there's a lot of truth behind all that, right? In the Fed, I don't think they want to pop their own bubble because, I mean, this will be the last bubble to pop. But it is interesting that they keep raising interest rates, but it is a confidence game. So the Fed has to keep raising interest rates once they start it, because if they stop raising interest rates, that signals to the market that the economy is weak, it can't handle any more interest rates, and then we're going into a recession anyways, and then the stock market falls anyways. So basically the Fed is cornered, so is Trump. And Trump has cornered himself for taking credit for this bubble economy, and the Fed has as well. And yes, the market since Trump was elected has taken off like a rocket because of Trump and his deregulation and his tax cuts, right? Well, here's what's going to happen. Trump's going to get the blame if the Fed pops its own bubble, and so is deregulation, and so is tax cuts, and then the worst thing that could ever possibly happen is if this bubble pops and then the free market gets blamed, tax cuts gets blamed, deregulation gets blamed, and then we get like a socialist president who ends up spending money endlessly and printing money with the Fed, and they keep giving universal welfare or income out, and what else are they going to do? I mean, it's going to be horrible. Raise taxes on companies, on entrepreneurs, on, you know, I do agree that the 500 fortune companies should pay a lot of taxes, but they already do, believe me. And that's why they also like inflating stock market bubbles, because it's easy for them to tax all the corporations that are on the stock market. So all that money that the Fed prints eventually goes into the stock market, creates a giant bubble, and then the federal government collects taxes on that giant bubble, and then has revenue to pay out the welfare and warfare and all the crap they do. All right, so yeah.
System. How does your interaction with those two presidents work? When a relation works well, what happens?
Well, I had a great relationship with President Bush, who initially appointed me, and I worked with him in the White House for a time, and also with President Obama, who reappointed me. Both of them were very respectful of the Fed's independence on short-term interest rate decisions. On a few occasions, in fact, President Obama wryly commented to me that he's been criticized abroad for Fed actions, and he had to tell them, no, it really is not our bailiwick, and that the Federal Reserve is making us. It was a difficult time. Yeah. So I had a good relationship with both of them, and I think it worked well. That the Federal Reserve is, of course, its goals are set by Congress. It is accountable to Congress. The Fed has become more and more transparent over time. I want to congratulate Jay on adding the 4 additional press conferences every year. It's very.
No, they haven't. They're not transparent. If they were transparent, they would do what Ron Paul wants, and that is to have an audit of the Federal Reserve. It's never had an audit. And if you would audit them, you might find out that they've been buying stocks, which they shouldn't be doing. And, I mean, other central banks do buy stocks, though. Swiss central, they all do. I know Japan owns like 40% of their stock market, their central bank, which is, Japan is essentially just really socialist. And they haven't had economic growth since the late 1980s, and they've been stuck in a recession for essentially 3 decades now. And by the way, these federal chairmen, they haven't been independent from politics. I know Alan Greenspan hasn't, I know Ben Bernanke, and neither has Janet Yellen. But this time around, they seem to not really play ball with the current president, Trump. And that's what I've noticed. All right, guys?
Of course, that be accountable, transparent, but it makes best outcomes occur if are done independently in a nonpartisan way, looking at the long-term goals of the Fed. And I think Jan and I were very lucky that Presidents Bush and Obama were very respectful of that, and I think it worked well. I had a good relationship with the Treasury Secretaries, with the other administration officials, and kept them well informed and had, again, a friendly relationship. So I thought that was an ideal arrangement. During the financial crisis, we had to work, the Fed and the Treasury had to work quite closely on those issues, but I would separate some of those issues from the monetary policy decisions, which are always left to the discretion of the Fed.
Do you see President Trump's approach as problematic?
Yeah, I think everyone would be better off if it was clear that the Fed is making its decisions based on its mandate and on assessment of long-term needs of the economy, which I'm completely confident that we'll do.
Dr. Yellen, do you believe that the president weighing in the way he has poses long-term dangers for the Federal Reserve and its independence and sound monetary policy?
Well, I think only if it served ultimately to undermine public confidence in the Fed and the basis for its actions and its responsiveness to its mandate. It had been a very long tradition. I think began really with President Clinton for presidents not to comment on particular Fed decisions. And I think that helped shore up the independence of the Fed and public confidence that the Fed was acting in a non-political way and, as Ben said, trying to make its best judgments to pursue its congressional mandate. I think that's the best kind of arrangement for a president vis-a-vis the Fed. Obviously, the president has a right to comment on the Fed, but I would worry that if it continues or intensifies, that it could undermine confidence in the Fed and the market confidence in the Fed.
Well, that's true. I mean, if Trump keeps saying, if he keeps tweeting and commenting about the Fed, people are going to wake up to the fact that the Fed has created a giant bubble and they're going to prick their own bubble. And they know that. Janet Yellen just pretty much admitted to that. Like, you don't want the confidence of the market, you don't want the market to lose confidence in the Federal Reserve. Because once they do that, their money printing, interest rate policy, all of that stuff just doesn't work anymore. And then people might wake up that the bubble's going to pop. And there's nothing they could do to stop it besides print more money. And by printing more money, it only delays the inevitable, and all it does is just create massive amounts of inflation. Now, at the end of the day, people think out there that we could just go back to a gold standard, and no, we can't. We can't until the trade deficit is fixed. Because if you go back to a gold standard and the trade deficit isn't fixed, all the gold in the United States would be pretty much withdrawn because we have a trade deficit. You understand? So, I think I'm going to stop there. Everything else they talk about is just a bunch of mumbo jumbo. If you guys like this video, if you liked my commentary, thumbs up, share my videos. There's WolfPack Cryptos. We do cryptos. There's private membership area where we do research, and I teach you guys how to trade. And then there's MMG Invest, which is more geared towards traditional markets, equities, and gold and silver, mining stock research, and stuff like that. So subscribe to MMG Invest YouTube channel and WolfPack Cryptos YouTube channel. Or at least subscribe to one of them if you're not into the other. Alright guys, until next time.